Hello and welcome to Cafemutual YouTube channel. This is Nishan Patnaik, Associate Editor, Cafemutual. Friends, Quantum Mutual Fund has been doing a lot of activities for MFDs. In fact, the fund house has become title partner of the industry's largest event for MFDs, Cafemutual Ideas Fest. In today's episode, we have invited Chirag Mehta, CIO, Quantum Mutual Fund. Chirag has close to 2 decades of experience in the financial markets. Notably, Chirag was featured in the list of top 40 fund managers under the age of 40 globally by CityWire UK in 2017. So let's welcome Chirag to our show. Good evening, Chirag.
Good evening, Nishan. Thank you so much and a pleasure to be here.
Chirag, so we have been seeing equity market. So it's so volatile these days. So what is your medium-term outlook on equity markets?
So, if you see, if I can put it this way, that India is shining while China is fading, right?
Hmm.
So, and there are certain factors that is driving that shine for India. So, if you look at the economic per capita GDP for India, it's about $2,200. And when we have seen many other economies who have moved past the $2,000 per GDP mark, they have kind of leapfrog from there, and the growth has been accelerating post that. And there is a rationale behind that. Once you achieve a certain threshold of income, you move beyond sustenance towards discretionary spending. That is what is happening in India. We are moving past the roti kapda makan and into things that we all desire and want to have at some point in time, right? So that is what we are seeing India transform into. Also, there are underlying levers, right? For example, home affordability has been a great catalyst for growth because if you see home affordability is at peak currently of last 15, 20 years that we have seen, and that has not been driven by anything else but affordability. Home prices were stagnant and incomes were moving higher. That has led to affordability, which is driving real estate sales across the country, and especially into the premium segments. So as people buy house, it has a cascading effect over the economy, right from materials that get into construction to other discretionary spends that people do along with buying houses. So that has led to a big cascading effect across the economy. Also, if you see infrastructure has been expanding fast, uh, government capex has led to infrastructure developing across the length and breadth of country. Look at roads, ports, railways, etc. It's been expanding very fast, and this will drive consumption, and at the same time, consumption will drive further private capex. So overall, India should be ready to absorb more FDI flows given the infrastructure expanding, given the consumption story that we have. And also, if you see from a trade perspective, India's trade with the world is rising. India is featured more and more in China plus one, global supply chain discussions, globalization of services also presents a unique opportunity for India to where we are positioned today. So if you look at one statistics, export of services today is more than our oil imports for the first time ever. That has never happened before, and that tells you that your reliance on certain or impact of certain things is now lesser. For example, oil prices, whenever they rose, it used to have a big impact on India. Now, the export of services is helping us pay the oil import bill. Also, at the other end of the spectrum, we have very strong corporate and bank balance sheets. So that is driving another confidence for foreign investors investing in Indian markets.
Hmm.
And when you have that strong and healthy balance sheet, it helps you put in the next leg of growth that everyone is looking for. So overall, we are in very good shape. I think there will be a lot of flows that will come into India, chasing the growth that we have to offer, chasing the strong balance sheets and strong economy that we have to offer. Also, on the other hand, the helping factor is moderating inflation. Moderating inflation helps in two ways. One is reducing the cost of debt, interest rates come down over a period of time, and also the input cost pressures for corporates are declining. So that is going to really help in terms of driving corporate earnings. And talking about earnings, earnings trajectory has been an uptrend for the first time in a decade. Last 2 3 years, we have seen increase in earnings post COVID, and I think that trend is set to continue given that we have healthy growth, we have reducing cost pressures. So revenues are increasing, that is translating to profitability for companies, and we don't see that changing significantly going forward. So we are seeing upgrades for companies in terms of earnings. We are seeing positive commentary from companies. So all that is leading to a good scenario for India. Index valuations, if you see, they are around the long-term average, and with the impetus on earnings growth, I think we are in a good shape overall. So Indian economy, which is a driver of stock market returns at the end of the day, is in a strong wicket. So if you see valuations slightly above the average, so you need to be cautious on indexes, but there are many opportunities outside the indexes that you could look at. Flows, we think that flows will increase significantly over next 2 to 5 years. Economic activity, I think there may be some slowdown because exports may get affected if there is upheaval in the external world, but domestically we are doing fine. And from an earnings trajectory point of view, I think the discretionary spend will lead to earnings growth for many, many sectors across. So overall, we think that we are very positive on the equity market outlook going forward. Only thing is much of it is captured in the price. Some of the sectors are expensive, but there are opportunities where we see value. So overall, we think that we will do extremely well as an economy and as a stock market.
Great. Good time ahead for investors as well as India. Okay.
Absolutely, Nishant.
Chirag, so political landscape has a lot to do with the country's growth. So we have Lok Sabha election around the corner. So what will be the impact of outcome of 2024 election on markets according to you?
So if you see, the majority is expecting and favoring that Prime Minister Modi will return to power with his popularity showing no signs of waning today. It is also evident from the state election results that we saw, and also thanks to the fragmented opposition that we have. So overall, markets are speculating all the possibilities, but the majority remains that there could be a Modi re-election, and which is touted as a positive for markets. If there is any upheaval, that could be negative for markets. But at the end of the day, at Quantum, we want you to step back and answer the question: do elections matter? Over the long run, we have seen that elections have had very little impact on growth. If you see across governments, right from 1980 till 2023, 20 plus years, different governments have come and gone, some single party, some coalition, and whatnot has happened in India. Flood, famines, assassinations, higher interest rates, lower interest rates, global financial crisis, etc. We've seen it all. And despite that, our growth has continued at 6.2% per annum GDP on a real basis. So we think that that's not going to change, and that emanates from the fact that we have something called as internal consumption, and that is the backbone of this 6.5% real GDP growth rate, and we don't see that changing. Major economic policies have continued over governments. We have seen right from infrastructure building to trade liberalization to easing FDI norms, divestment from PSUs, financial inclusion, etc., being driven across governments. There are many governments who have started something, executed by some other government, and benefit of them accrued in the subsequent government. So we have seen it all in terms of how that panned out. For example, the Aadhaar program was constituted, or the work started in the UPA government regime between 2004 to 2014, implemented largely by the NDA government, and now they are fetching the benefits of the Aadhaar, or the JAM Trinity as we called it, Jandan, Aadhaar, and Mobile. So overall, we think that there will be reforms that will continue over a period of time, and that's not going to change. But the trajectory of growth, we think, will continue to remain at the 6.5% real GDP growth rate, which is a very, very respectable growth rate in today's world. And if you see from an election outcome perspective, we have seen that there could be some nervousness or some rejoicement post-election result. Sometimes market get euphoric looking at the election result. Sometimes they may not be so excited about it. But overall, we have seen that we are standing currently 3 months before election, and if you were to see 6 months after election in that 9 month period, or if you see 6 months before and 6 months after, usually markets have tended to be positive in that duration. So, barring the election volatility, I think if there is any volatility, that's a great buying opportunity because post that markets tend to be positive. And given the economic scenario that we are in today, I think markets should be okay going post election as well. So if there is any nervousness, I would say that bank on the fundamentals. We are in a growth scenario, and we have a lot more things going on for India as an economy. So I think you should be an investor. If there is any volatility, use that to your advantage, and irrespective of the election result, continue to stay invested in the India growth story.
Chirag, while equity market are at all-time high, but many
Yes.
distributors are finding it difficult to deploy the incremental flows they are getting, especially through lump sum. So, what is your suggestion to them?
Absolutely. So I think, see, valuations matter at some point, right? And valuations are not cheap today. There is very little room for disappointment. We are priced for perfection, and we are kind of at some areas or some pockets, we are pricing in many years of earnings growth.
Mm.
So overall, it's a tricky market, it's a tricky situation. But the simple mantra remains that if you are under allocated to equities as an asset class, please continue to build your allocation in a staggered manner. If you get any volatility, use that to your advantage, and that is the time to go in lump sum. But otherwise, continue with a staggered investment. And also important is rebalancing. Rebalancing not only across asset classes but even within the asset class. For example, today small caps have given great returns over last 2 years. It could be a time where you are, if you are over allocated, don't just do for the sake of doing, but if you're allocated to small caps in a significant manner and it's become a huge chunk, if you wanted it to be 15-20% of your allocation and it's become say 40% of your allocation, then probably it's time to rebalance. Otherwise you could stay invested in that. So use prudent judgment in terms of ensuring where you are in terms of your allocations. And if you're under allocated, continue to build your allocation, because we think that barring smaller corrections, which you should be ready for any point in time in equity markets, barring those, I think we should be looking at good growth in the economy and in equity markets going forward. So overall, look at your allocations and make the right judgment.
Yeah. So, Chirag, we have observed that in the bull markets like this, many MFDs
Yes.
get carried away and recommend performing fund categories like mid and small cap funds to their clients. So, how can MFDs identify their own biases and how can they overcome this?
Yeah, so yes, it's easy to get influenced by what's happening in markets. We do understand that fact. Uh, so one very simple way to do is build a model asset allocation. Irrespective of the market scenario, you should always have a model asset allocation that you should have in place. And if there are large deviations from your model asset allocation, then you should, try and take action in terms of bringing back or to your what your model asset allocation recommends. So I think uh, if you have the risk return profile of your investors, then probably build a model asset allocation that suits them. Look at the deviations. If there are large deviations, please try to correct them over 3 6 month period, and I think that will do very well. Yeah, I mean, this is coming from experience in terms of even when we manage a fund, we do have a model portfolio that we kind of build, and we stick to the model allocation because it's very easy to get influenced by what's happening in markets. And if you have some point where you kind of have reflection from, that's a great way to bring it back to the original levels, because that is what you are intending to do and not get influenced. So when you have a model asset allocation and you try and compare every month, every quarter, every 6 months, whatever time period you choose, And if there are large deviations, then that's the time you take action and slowly bring it back to the original model asset allocation that you thought is the right way to build that portfolio. So I think if you go by a standard mantra of a model asset allocation, then I think there are lesser chances you'll be prey to all these policies of and biases that kind of deviate you from your original goal. So I think we do practice it. I think it's time that MFDs can also use that as a tool where you can deviate back to and not fall prey to all these biases.
Okay, but Chirag, many MFDs are yet to practice asset allocation. So
Mhm.
we would like to understand that what stops them from doing it and what are some practical tips to practice asset allocation?
So asset allocation is very, very important. There are many studies that have said that much of the deviations or much of the return explanation comes from asset allocation. So asset allocation is the key. I mean, irrespective of any market scenario, be it the global financial crisis, be it the COVID crisis, or any crisis that comes and hits you, I think if you are asset allocated, you will not lose sleep at night. So it's very, very important to practice asset allocation. And I think the pitfalls that are generally that impact asset allocation or practicing asset allocation is the biases that we talk about, right? One is return chasing bias or a familiarity bias. Those are the things that stop you from adopting a prudent asset allocation strategy. So I think whenever you look at a client, understand the risk return profiles and build a model asset allocation. Once you start with that, I think your job is done. It's only then comparing at certain time periods with the model asset allocation. And I think you will never regret and never lose sleep for you and your client when it comes to markets, be it a bull market or a bear market. So I think asset allocation allows you to build wealth more structurally and not deviate from building wealth, because once there is a crisis, you will lose a lot of money unless and until you are allocated in the right manner. So, so I think we have seen that asset allocation strategies have performed over cycles much better than your direct equity or direct fixed income or a direct gold or real estate investing. If you have allocated well over a period of time and rebalanced well, I think you will end up making more money and be lesser impacted by the risks that hit you when you practice a prudent asset allocation strategy. So I think there is numerous studies. We have done asset allocation studies, and we have seen that risk, not only risk reduces, but also your returns are very, very similar to what your top asset class has delivered, or even better at times. So I think there is nothing that should stop you from practicing asset allocation, and the starting point to that is to have a bucketing of your clients and drive a model asset allocation for that bucket, depending on the risk return profile that your investors are looking for.
Okay. So Chirag, two popular schemes of quantum mutual fund, that is quantum long-term equity value fund and quantum ELSS tax saver fund. So they both did not beat their respective benchmark in the 5-year period. So how do you plan to regain the performance momentum of these two funds?
Sure. If you look at what quantum banks on, is not only driving the top return, but driving a consistent return, which is more predictable. You wouldn't know, 2 days later what you're going to eat, but we could predict the what will be an approximately NAV of the fund 2 years out. And if you see since 2006 when the fund started, we have been right on most occasions, barring a couple of dislocations that were hit because of the external events. So
Mm.
in both, the strategies are very, very predictable strategies and therefore bankable strategies. Having said that, if you see the recent performance, we have recouped a lot. In the 5-year period, also there is a period between 2017 and 2019, which was not conducive for value investing as a style, not only in India, but globally. But post that, post COVID, there is a lot of rationality. The interest costs have gone up, inflation has gone up, and that has led to many valuing stocks in a more prudent manner. And in this scenario, we have done extremely well and beaten our indexes. So one is to we are recouping our performance and our performance has picked up. But more importantly, we will want investors to understand that we give a more predictable set of returns to them rather than giving what is unpredictable, unbankable returns. So if you want something that is more predictable, and I think investors should make it a base of their equity bucket, because at the base of the bucket you want to take lesser risk and you want more a predictable approach or a predictable outcome, and therefore that's more bankable, and therefore that becomes the base of your equity investment. And higher you go, you could add more risk, which is more unpredictable, unbankable, but you are trying to make good risk adjusted returns in that allocations. So overall, what I would say is, look at it from a different lens. Don't just try to compare with the top performing funds, because time and often we have seen that what's top today is not top tomorrow, and therefore that trend changing would lead you to a different outcome, and you will be chasing returns. Rather than chasing returns, I would say that look at what is more bankable, more predictable, and therefore more consistent in nature, rather than looking the top performing. And as I said, that returns have been improving significantly as the cycle plays in our favor, and the kind of portfolio that we have built. So I think investors should look at making it a base and benefit from a more predictable outcome that we try to deliver.
So, Chirag, Quantum Mutual Fund has been doing a lot of activities with MFDs. So, how has been the response so far, and how are you changing their perspective towards the fund house?
So we are looking forward to work extensively with the community, which we believe plays a pivotal role in taking financial markets to the masses and ensuring their financial well-being. So we think that the mutual fund distributors do a great work to help us reach those clients and also handhold clients towards their financial journey. So we are engaging with MFDs in a much bigger manner. We have increased our engagement with them. So far, they were not knowing us so well, not knowing us so closely. We are introducing ourselves, telling them about our journey, telling them about their products, our approach, and I think we are getting a great response from them. We see that receptivity, we see that engagement, we see that willingness. So I think it's only going to increase from here, and we are eager to lead that path when it comes to engaging with the MFDs. So I think it's been a great start, and I think the journey will only deepen from here.
One last question, Chirag. So,
Sure.
Quantum Mutual Fund is the title partner of Cafe Mutual Ideas Fest. So, what are the key takeaways that MFDs can expect from this event?
So I think Cafemutual Idea Fest event is a great event. I think I mean the agenda is full power packed, and I think there is a lot for every stakeholder that comes into being part of it. So overall, MFDs can look at some learnings on economy, markets, asset class outlook from the experts. They could also look at how they can enable business growth with some practical insights. I think that's one of the most engaging part of the event, and also learning from peers and thought leaders not only from India but also international ones. So I think there is a lot for everyone to take home. I'm sure it's going to be a great event this time again.
So, with that, we have come to an end to this interesting session. Thank you so much, Chirag, for your valuable time and inputs.
Thank you, Nishant. Pleasure always.
And I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.